It's May 1st, 2011, and this is video analysis from Burken Road Reports at Tulane University. Hello everyone, my name is Suhail Farouk and I will be going over the financial forecast for a very important Burken Road company, Key Energy Services. Key Energy Services is a publicly traded oil and gas equipment and services company with headquarters in Houston, Texas. Employing over 8,500 people, the company operates in most major production regions and provides major oil and gas production companies with a wide range of services. The company also has a very strong international presence in Mexico, Argentina, Colombia, and Russia. In the past, the company has seen great success, specifically in the past 2 years, as you can see on this slide. And we observed the company's stock price between April 17th of 2009 and April 15th of 2011. Within this time period, the company's stock price appreciated by almost 300%. When compared to the S&P 500, the index grew only around 55% over the same time period. Historically, the Burken Road teams have accurately projected the market performance of Key Energy Services and have assigned the company favorable credit ratings. In 2009, the company was given a market outperform rating suggesting that the stock price would appreciate by over 20%, exceeding the return of the Russell 2000 index. In 2010, the company was given a market perform rating implying that the company would increase between 0 and 20%, approximately matching the Russell 2000 index. In both the previous instances, the Burken Road analysts were correct in their predictions, and the company's stock price appreciated accordingly. Now, similar to previous assessments, we are also bullish of our outlook for Key Energy Services financial performance for the upcoming 12 months, and we are assigning the company a market outperform rating with a target price of $19.62. The company's forecasted target price implies an increase of 27% when compared to its closing price of $15.45 on March 30th of 2011. Price of the stock under different valuation methods can be seen in this slide. Even though for every valuation method we obtain different prices, we decided to use the EBITDA multiple solely to forecast our 12-month share price. The discounted cash flow valuation method was the first method we used in calculating our share price, and this method is based on time value of money. We use a discount rate of 9.14% and a 5% terminal growth rate for our valuation. Our target price turned out to be $19.72. We moved on to the comparable companies analysis method, and we first evaluated the price to earnings multiple. The price to earnings fundamental valuation method is based on historic ratios and statistics and aims to assign value to a stock based on valuable attributes. In mission to attain a forecasted stock price for the next 12 months, the PE ratios of comparable companies were evaluated. Based on this valuation, we calculated our target stock price to be $15.46. The price to book valuation method is based on comparison between a company's book value to its current market price. Using the average price to book value and the company's book value per share, we calculated our target price to be $16.66 under this valuation method. Now we turn to our most important valuation metric, which is the EBITDA ratio. Valuation of the company based on comparison between valuation of business free of debt to earnings before interest. We use this valuation method to determine the share price in the future. The reason behind our choice is its advantage to be unaffected by company's capital structure. Company's share price turned out to be $19.62 under this valuation method using the EBITDA ratio. We also use this valuation method because it was the most prominently used method by other analysts in their research reports. In our analysis, we focused on operational risks and regulatory risks. For operational risk, we determine environmental risk, foreign risk, and labor risks. Since the nature of the business is based on oil, environmental risks for the company are greater than other regulatory business risks that do not involve oil. Key Energy Services growth strategy is based around international expansion. Therefore, the foreign risks are also substantial for the company. Additionally, labor risk also constitute another operational risk that is sourced by the fact that the company has a high employee turnover rate. The regulatory risk involve health, safety, and environmental regulations. Health and safety is a prime concern for Key Energy Services given the work environment and the potential for danger. Now, in this slide, you can see Key Energy Services leverage and liquidity ratios as compared to its peers. As you can see from this slide, Key Energy Services does not stack well against its peers in majority of the ratios observed. Although the company's total leverage ratios are below the peer mean, its debt to EBITDA ratio indicates that the company may face difficulty in covering its debt in the short term. Similarly, the liquidity ratios indicate the same problem for the company. Finally, we evaluated Key Energy Services in terms of bankruptcy. The ultimate Z-score analysis for the last 4 years is seen in this slide. The analysis is instrumental in gauging the probability of a company's bankruptcy within 2 years. Simply enough, a Z-score above 2.99 indicates that the entity is safe from bankruptcy. A score between 1.88 and 2.99 indicates that the company is at marginal risk, and a score of below 1.8 implies that the company is financially distressed. As can be seen from this slide, for the year 2008, Key Energy Services score fell just below 1.78, which is almost at the financially distressed level, and it continued to fall down to 1.25 during 2009. We mostly believe this downfall was caused by the recession of 2007 and 2008. As you can see, the figure rose to 1.93 in 2010. This Z-score reflects the company's ability to recover from recession, and furthermore, it supports our claim for cause of its downfall. We believe that the company is completely safe from bankruptcy, and the Z-score will continue to rise more in the future. Thank you very much for listening. We thoroughly believe that the company is in solid financial condition, and therefore we assign it a strong buy rating. Thank you. Burkenroad Reports was created in 1993 and received national attention from media outlets such as the Washington Post, Barron's, Nightly Business News Report, the New York Times, CNBC, and the Wall Street Journal. The Burkenroad Reports are produced solely as part of an educational program at Tulane University's Freeman School of Business. The reports are not investment advice, and you should not rely on them in making any investment decision. You should consult an investment professional and or conduct your own primary research regarding any potential investment. Thank you very much. Bye-bye.